bubbles in different financial markets. So, firstly, I will talk on behavioral finance in the beginning, and a few examples on behavioral finance and a few other subjects. Then we will go on with hoarding behavior, and then we will go on with the bubbles in financial markets. And also, I will share some of my results from my research. So, what is the difference between behavioral finance and traditional finance? According to the traditional finance theory, people are rational. So the investors are rational. What does the rational investor do? He refers to the action or in the decision-making process, try to have the optimum level of benefit. A rational investor do like that. But the rational investors should maximize their references in investment decisions, and they will diversify their portfolios, and they would avoid risk. And in their financial decisions, for example, if any rational investor knows the level of risk, he would like to have the highest level of return. Or if there's a known return, and if there are two different investment types that he could do, he would select the investment, or he will select the portfolio with the minimum level of risk. So, but in financial markets, investors are not always rational. And what does the behavioral finance do? It proposes that psychological influences and biases affect the financial behavior. So, and also the investors and also the financial professionals in sector. And these influences and biases can be the source of explanation of all types of market anomalies. And in stock markets, we see some high rises and falls, some sudden rises and falls, and we try to understand these sudden movements with the help of behavioral finance. There are many different other subjects under behavioral finance. For example, under information processing, we have forecasting errors. That means when any people, generally people give too much weight to the last experience. And when you give too much weight to the last experience, then the forecasts are too extreme. And overconfidence, conservatism, sample size neglect, anchoring, hardened behavior is our subject today, emotional gap. These are many other related subjects under behavioral finance. Yes, for example, overconfidence bias. We really see it in the for the investors. When an investors think like you are investing in a stock, and when the price of the stock increases, the investor thinks like, yes, I know that, I need that this would be, but they really don't care too much the other information. This overconfidence is really dangerous for the investors, but generally they believe their own beliefs more, and they tend to overestimate their own abilities with this overconfidence bias. And we have a prospect theory. under behavioral finance, I want to give a few information about that too. This theory is developed by Daniel Kahneman and Tversky in 1979. And also, Kahneman had the Nobel Memorial Prize in Economics in 2002 with his studies on behavioral finance and prospect theory. And based on results from the studies, this theory describes how individuals assess in an asymmetric manner to their loss and to their gain. This is the basic idea under this theory. For the pain that from losing is if $1,000, it could only compensate by the pleasure of earning $2,000. But in the classical finance theory, with our calculations, with the statistics that we use, they would have the same effect. But when you look from the behavioral finance, it's different. Their effect is different on people. And this loss aversion is an asymmetric from the risk aversion, that the people react differently from the potential losses and potential gains. So their investment decisions can be different related with this loss aversion. So on the left side, you see that when we have a pleasure, 2 points is, if we have 2 points from our pleasure and we gain, and when we have losses, it's twice, our pain is twice. And also, there's another important thing related with loss aversion. If a gain is, if there's a sure gain in an investment, you want to have that sure gain and have that gain. But if there's a loss, you rather try to take a chance. You never select the sure loss, but then you rather take a chance. So these are related with each other. These gains and pains also affect how you decide in the beginning of your investment. And yes, now we came to our point. Our subject is today hoarding behavior. And in efficient markets, information is available for all the participants, all investors. And yes, they evaluate the information. They make their investment decisions with in same direction. And when the investors are rational, they make similar investment decisions. But sometimes the buying and selling the same securities are without a specific reason. We don't know the information under it. We only buy and sell with knowing the other investors' investment decisions. This is hoarding behavior. We only do that because the others do. So a group of animals fleeing from a predator shows the nature of herd behavioring. In 1971, in the oft-cited article, Geometry for the Selfish Herd, he's a biologist, Hamilton, asserted that each individual group member reduces to danger to itself by moving as close as possible to the center of the fleeing group. So thus, the herd appears as a unit in moving together, and this function emerges from the uncoordinated behavior of self-serving individuals. So here, for example, ship says that I don't know where I am going, where we are going, but from the look of this crowd, it's gotta be good, as our investors do in our financial markets. When they see that the others go in the same direction, they follow each other. But they don't know after what will happen. And the philosophers Soren Kierkegaard and Friedrich Nietzsche among the first criticized what they refer to as the crowd and herd morality and the herd instincts in human society. Modern psychological and economic research has identified herd behavior or herding behavior in humans to explain that large numbers of people acting in the same time at the same direction. And one of the reasons is sometimes some person is going against the norms of some culture. He could be unsettled by the society. And also some people believe in superstition just because everyone else around them is also believing in them. Here, I will open a YouTube movie. I hope there won't, okay. I selected the noise. Now, this is a really interesting experiment. So I have included it in my presentation. I hope you like it.
To answer that question, we set up a hidden camera experiment to see if this woman would stand up at the sound of this tone, simply because everyone else is. You might be thinking you'd never go along with this. Or would you? After just 3 beeps, and without knowing why she's doing it, this woman is now conforming perfectly to the group. But what happens if we take the group away?
Elaine, please.
Okay, now she's alone. The crowd is gone. Nobody is watching her, except our hidden cameras. What do you think she'll do? She's now conforming to the rules of the group without them even being there. Now, watch what happens when we introduce another outsider who doesn't know the rules.
For a noon appointment. Have a seat and they'll be out in just a couple minutes. Great, thanks so much.
Everybody was doing it, so I thought I was supposed to.
Think she'll teach the new guy what to do? We kept the cameras rolling as more unsuspecting patients arrived. And slowly but surely, what began as a random rule for this woman has now become the social norm for everyone in this waiting room. Here to explain what's going on in their brains is Jonah Berger of the University of Pennsylvania.
This sort of internalized form of herd behavior is part of what we call social learning. Starting at a very early age, when we see members of our group perform a task, our brains literally reward us for following in their footsteps.
When I saw everybody stand up, I felt like I needed to join them. Otherwise, I'm like excluded. Once I decided to go with it, then I felt much more comfortable.
Conformity is how we become socialized, but it can also cause us to develop bad habits or repeat past wrongs.
And it's why even this rebel, who wasn't standing for any of this nonsense, eventually joined the ranks. And the only thing more shocking than seeing how easily conformity affects the way you act is that similar forces are subconsciously shaping the way you think.
I hope you liked it. Yes, we are not very complicated. We are not very complicated. Sometimes we really behave like the animals. These are our instincts, and we try to behave like the whole community and the others. We learn this in our new age, or when we in our childhood mostly. Yes, I'm a finance professor, so I don't know the most details under it. The other psychological area, for example, professors, they know better. But this is a really good experiment to understand ourselves. So in financial markets, other investors try to achieve the same result. But generally, a small group gain, and the others only move in the same direction. So sometimes in a very short period, we see the effects of this behavior on the financial markets, and sometimes it takes a longer period. It takes a longer period. So related with this herding behavior, we generally try to understand the price bubbles in assets in financial markets or in commodities, but not only the herding behavior is the one effect under price bubbles. There are also some other explanations than the herding behavior. And what is a price bubble? We see that if there are separations in financial assets from the random walking process, then we see that there's also separation from its real value. And also sometimes investors are aware of this separation, but they think it's a good chance. And they continue to expand, and they think they will provide a high yield from this separation. In Turkey, there are a few known professors writing on cryptocurrencies. I was from the, and also I was one of the first professor that supervised a thesis on cryptocurrencies. And whenever in cryptocurrency markets, the prices are increasing in a high speed, many people began to ask if I would invest. But when it's going down, No one asks, because they see that and they think that it will continue, and they want to have that gain to their own portfolios. And durability, scarcity, and common beliefs are also associated with the main actors cause that price bubbles. And Delak also explained bubbles related with that behavior of noisy traders in financial markets. We explain noisy traders as yes, the information is coming to the market, but they really don't make their decision related with that information coming to the market. So, yes, the hardening behavior under behavioral finance is important in bubble. It have got an important effect under bubbles. And uncertainty in financial markets cause the bubbles. The noise related with the, as I had just explained, the noisy traders. The common beliefs, again, the scarcity, durability, these all can have effects on bubbles. And when you look to the theory, when you look to the literature, analyze then the bubble periods. So where did the first